I'm Valentina Sanchez Cuenca. Welcome to another episode of Where's the Trade? Today, we're here again with Larry McDonald, CEO of the Bird Shops Report, and also one of our longtime friends, James Robinson. He helped structure the whole thing around Larry's first book, A Colossal Failure of Common Sense. And of course, he's the author of our upcoming book, How to Listen When Markets Speak, which, by the way, you can get in the link in the description below. Guys, where's the trade?
Thank you, Valentina. Would now be a good time to tell everyone that you're a recent contender for Miss Panama, because you were, and that was very, very brave. A lot of charity work. You are not just a very beautiful girl on Larry's cup. You are a rising star in Panama. You'll probably be the president one day.
Sure thing. Thank you very much.
So, Larry, everybody's dying to know, what are you seeing in the markets today that might just be worrying people who are invested, or giving people some hope?
Well, I'm really grateful to you, James, and your dad. Our first book, Colossal Failure of Common Sense, is a New York Times bestseller. It's now in 12 languages, and it was voted by the CFA Institute. It's one of the top 20 books all time. And so we're looking forward to our next book, When Markets Speak, in the first quarter. It's going to be a big launch, and we're going to give you some kind of an insights, kind of looking down the road ahead, coming out of our book and looking behind me. So behind me, we have a Bloomberg chat, very revolutionary concept where we host a conversation every day with institutional investors in about 23 countries. And these are professionals. These are people that are running risk right now behind me. And the big thing today, the Treasury auction was, kind of a huge dud. It kind of shocked people. And of course, Powell and the Fed governors, they're doing this good cop, bad cop kind of rotation back and forth the last 10 days. And so they kind of show the markets a little bit of hope toward a softer path, and then they've been walking it back. And so that's why I think we rolled over pretty hard in the market, because I think after the Fed meeting, it looked like, God, this is going to be a much softer path. And now the Fed speak this week from Governors Logan and Bowman, and now Powell speak to potentially not so much a softer path. But the data, which we'll get into in the charts, really point to a much softer path down the road ahead.
So, Larry, what do you believe? Do you believe that there's going to be a soft landing, or are you in the hard landing camp? Or maybe you're in the no landing at all camp?
Well, if we look at the charts, it's very clear in talking to professional investors behind me every day over the last 3 weeks, there's been kind of a sea change in some of the consumer data, and the companies that have been reporting earnings, from Upstart to all kinds of retailers, any company that faces the consumer has been showing lots and lots of pain. And as you can see here in this chart, bankruptcies, this is kind of, everybody talks about, the soft landing, but think about how bad 2020 was. I mean, think about how you felt in 2020 about the economy. And U.S. bankruptcies this year are essentially on the same pace. We're at 561 there, right? 561 on the right-hand side of the screen. That's year to date as of the end of October. And that's at the same pace as we were in the 2020 in October. I mean, think about that. Think about October 2020 in your mind, and then think about October 2023. And we're essentially at the same exact pace. So
Larry, what's knocking these companies out? Is it the debt profile? Because, I mean, obviously everyone's seen the WeWork story where they just filed for bankruptcy. That has to be the debt profile and the interest rates that are so much more expensive.
Yes, I mean, like, your average person, the Fed has been told us for years that most families only have $400 or $500 in the bank, enough, very little savings. Most American families, that they've lectured us on this. And so when interest rates on car payments go from $200 a month to $600 a month, it makes consumers really pull back. And the CEO of Target the other day mentions, people are buying less items. Upstart, as I mentioned last night, reported, higher delinquencies or higher charge-offs, which is, this is a subprime lender. Like, anybody that faces subprime customers, like people with low credit scores, is experiencing lots of pressures. That means companies that sell products to middle class families are seeing less traffic, for example. And that's why if you look at Chewy or some of the companies in the pet space, I mean, the pet space, CHWY, these companies are down like 50, 60%. And they're great leading indicators for the economy because it's the first place people come back. You're not going to buy that second dog leash, for example, And so any company that faces broad consumers on a retail level, most of them are showing lots of pain in the earnings calls. And that, like you said, that's coming from tighter financial conditions, higher interest rates right there.
And does this all guarantee that we're going to enter a recession, or are we already in a recession? I mean, where do you even draw the definition?
Well, one of the things we talked about in our first book is when I was at Lehman in the fourth quarter of 2007, around that time, GDP was actually, in the third, fourth quarter, GDP was above 3%. So people were telling us things were really strong. So I lived through this. So in other words, you're reading the paper, you're watching CNBC or whatever, and the mainstream news, the concept was, things are okay, we're decoupling. And lo and behold, like a year later, they told us that we actually entered a recession in the fourth quarter of 2007. And when you live through it, the data that was coming out, what happens is they report the data and then they adjust it down the road. So as you're watching the news cycle live in 2007, even though we're on the cusp of one of the greatest financial crises that we've ever seen in the history of the world, but when you live through that live time, and you were reading the paper or watching television and keeping track of the financial news, it wasn't being reported that way. And
they bleed the truth out, right? They bleed the truth out so they don't completely spook the markets and freak everyone out. Is that it?
Well, yeah. Well, that's what central bankers do. They will spin. And don't forget CFOs too. So if you're a CFO of a Bank of America, any kind of big consumer-facing company, the last thing they want to do is scare consumers to pull their deposits out of the bank or to stop borrowing. So there's an entire ecosystem of CFOs and central bankers that will exaggerate a soft landing just to keep everybody as calm as possible. And as you can see here, we've heard so much in the last month about how strong the job market is and how and how strong the consumer is. This is what we're hearing from the Fed. We're hearing from different, Brian Moynihan of Bank of America has been talking up the consumer. But if you can see here, jobless claims are breaking out. These are continuing claims. They're nowhere near dangerous levels, but the rate of change, if you look in the far right corner there, that's a pretty sharp rate of change. If you extrapolate that out, and then if you listen to conference calls, over the last couple of weeks in terms of this earnings season, it definitely feels like I think we're in a recession, and I think they'll probably tell us that, 9 months from now.
And how much do you believe the jobless claim numbers? Because I know that you're a very bearish trader. I wouldn't call you a vulture, but you were definitely on the distressed debt side. Do you believe these numbers? Do you take it as fact, or do you always think that it's probably so much worse than they're letting on?
Well, we've already seen what the jobs numbers, 8 out of the last 9 months have been revised up. And I think it's over $300,000 jobs that have been reported after the fact lost. And so I've never seen that. I'm sure someone can find it in history, but 8 out of 9 months, when they reported the jobs on the non-farm payroll, what happens is then all of a sudden, like a month later, they revise it up, and they've done that like 8 out of the last 9 months. And so, yeah, they're bleeding out the truth one drop at a time. They're trying to keep the fannies in the seats. They don't want to create a panic. And I don't trust the jobs numbers because, matter of fact, if you look back historically at the end of the .com, right before the .com bust, right, which is one of the biggest financial calamities we've ever had, the jobs numbers were quite strong. So the .com bust started in like March of 2000. And if you look back, like I think it was January, February of 2000, the jobs numbers were quite strong when they first hit the tape. So you just have to take a little bit of a skeptical eye towards some of the data.
And so you've been looking at the data coming out of the Treasury, coming out of the sovereign balance sheet. And I have to say, in the Bear Traps report, you have never said that this inflation is going to be transitory. For the last 2 years, you were literally the first person to say this inflation is going to stick around for a long time. You need to get long everything that inflation loves, which is, hard assets and commodities and industrial stocks and value stocks. And you've just nailed it. Now, you don't believe the numbers coming out of the Fed when they're profile either, do you? Like, you think that the story is a lot worse than they're letting on.
Well, the whole concept of one of the key principles of our next book, we're on the cusp of the greatest migration of assets, moving from financial assets to hard assets that we've ever seen. This is going to be a historic event. It's already in the early innings. It's been happening very slowly. But inflation, is once it gets under the seat cushions, once it gets under the carpets, it's so hard to get rid of. And what we've done, in our book, we talk about the Lehman response to COVID, right? I'm sorry, the Lehman response versus the COVID response in terms of the fiscal and monetary response from the Fed and the Treasury. And so the response to Lehman was about $3 trillion, fiscal and monetary. But the response to COVID and the energy crisis has been about $14.6 trillion, including this year's budget, which has got close to $2 trillion of deficit spending. So you're talking about a close to $15 trillion fiscal and monetary response since 2000 versus Lehman's response in the fiscal and monetary side in Washington was just under $3 trillion. And so that has really created far more sustainable inflation. And you're seeing a much bigger power of labor. Labor unions are empowered now more than they haven't been in years. And you're seeing this what's called reshoring and onshoring. Trump started this, and President Biden's picked up the throne, picked up the torch, and the whole CHIPS Act is trying to bring jobs back to America. And so all of this is when you bring jobs. Think about it. One of the things we talked about in the book, James, we took 5 million jobs out of the United States, 5 million in the last 30, 40 years, and we shipped them to Bangladesh, to India, to China, and we've raised the standard of living in these countries. And now these countries are much more powerful energy consumers than they've ever been. If you're a young person in India, you're consuming 1,000 times more energy or carbon than your great grandfather today if you have a moped. And so that's all creating much more sustained inflation than we've ever seen. And this chart here, James, I think you talked about student loans in our last segment, but what's interesting here is you've got a big jump there in payments. In other words, that all kicked in October.
Okay, so that red line on the right-hand side, I was asking, is that a reset? Is that due to the latest interest rates that students are now facing on their loans?
Yeah, so behind me in the chat, one of the things in the last 3-4 weeks that clients are talking about, we're talking about professional investors that run money around the world, is that something happened in September, in October, in the data. And when you listen to the conference calls, and we've listened to over close to 60 calls, Valentina and the team and Robert, there's something going on around consumer spending in September and October. And I think it has a little bit to do with this. It's 40 million Americans now have to pay an extra $300 a month. And you can see that people were probably changing their behavior in August, September to get ready for this. And that's where you're seeing this recent move up in consumer stress in the third and going to the fourth quarter. And I think a lot of it has to do with the student loans, where there's all of a sudden a family that was already a little bit stressed, now has to really cut back a little bit more to make those payments on the student loans.
So, Larry, I've got a question for you, and it's a question that it's not really necessary to ask it in this particular podcast, but what do you read on a daily basis? Like, what's your kind of information diet for someone that needs to stay on top of the markets, just so people at home that are managing their own money can kind of be in the game? Obviously, you have to read the Bear Trap book, but where do you get all of your knowledge? Is it just from speaking to lifetime connections and getting on the phone, or are there publications out there that you subscribe to?
Well, obviously read the Journal and the Financial Times. I think it's the best for global coverage of what's happening. Business Insider is another one that we check. Jared Dillian, Daily Dirt Nap, he's fantastic. And so we've got different partners. But I think the best thing is in the morning, we start the conversation around 4:30 or 5 with the clients that are in London. And so right behind me, so it's a live conversation on Bloomberg. And what we'll do is we'll start talking about the news cycle, and clients will put in stories they're reading coming out of Bloomberg, coming out of major news sources, Axios, on the political side, Punchbowl, and we will get these stories. So it's kind of like crowdsourcing information. So instead of reading the paper the old-fashioned way, right? Okay, and you don't really know what you should read. But when we run the chat live with hedge funds around the world, people are picking up the stories that they think are most influential on the markets. They're feeding them to us. Then we're putting that together with charts and analytics and kind of like, okay, what's the follow-on implication? So if it's a story about, say, a consumer lending company, you say Ally Financial, or say there's a news story about auto loan financing and auto loan defaults. And then all of a sudden we'll look at Ally Financial equity chart. We'll look at the credit default swaps. So we take the news story that maybe is about, say, auto finance or stress in the auto finance community, and then we'll pick out a couple of companies and we'll look at the credit default swaps, which we're trying to say, okay, what's the rate of change on the cost of default protection? And that's a great leading indicator, because if professional investors are shorting the company or shorting the company's credit because they think that the company might fail, that ties that news story to the markets, much more closely. So we're looking at the credit and looking at the equity. Typically, credit leads equities.
Right. And I remember, I think it was January or February that you mentioned in one of the turning points that the sector that's going to get hit hardest and maybe first, or just any sector, but you said especially the auto sector, because and I'd never thought about this, because that's a sector that really is 100% reliant on financial conditions and lending. I mean, it's literally no one goes in and buys a car in cash. No one goes in and leases a car and says, yeah, here's 30 grand. They all take it on a month by month, rolling interest rate that's likely to change. It's a very interesting look, and I hadn't thought of that before. I never thought the car industry was completely finance.
Yeah, it's amazing. I mean, what percentage of cars and I mean, remember like 2-3 years ago when rates were zero, they were like 6-year, rates were so cheap that people were actually financing a car for like 5 or 6 years. I mean, that's unheard of. Like when I was coming up in the business, at the most you would get like a 2-3 year car loan, right? But people were doing like these 6-year, low interest rate. And then now that rates have been shot up, that's just putting tons of pressure. And that's why you're seeing restaurants, like the restaurants are underperforming the NASDAQ by a large margin, by close to, I think, last couple of years, close to 25-30%. And so companies that face consumers day to day are underperforming, kind of like the big companies are outperforming the broader basket of companies by the most all time. This week, the spread between the Russell 3000 and the NASDAQ hit an all-time high.
Amazing. And a chart that I saw, I think it was in one of your client recaps, maybe this Monday or Tuesday, was the amount of new listings coming into the market in the housing sector. Why are people selling their houses in a time like this? Is it to raise capital? Because you would have thought that it's a one-way street if you sell a house now. Because getting in, you got to get a mortgage of about 8 or 9% to get into a new property. And, that 5-bedroom house that you might be buying is now a 2-bedroom house for the same payment per month. I mean, it's incredible how much of a downgrade you get for the same amount of money. So why do you think there are so many more listings coming onto the market?
Well, for a while there haven't been, right? Because as rates went up, if you were in a house with a low mortgage, you didn't want to sell, right? And that's why for a long time, for the last year and a half, there's been less supply of homes, and that's why the home builders are doing so well. So if you listen to the call of D.R. Horton or Toll Brothers, the home builders have really killed it. We did a trade alert buy on GRBK Green Brick about a year ago, and I've it's one of David Einhorn's favorite stocks, great value stock. But these home builders have done like incredibly well because there hasn't been a lot of listings. Now, to your point, this is what I'm hearing in the chat. The fact that listings are now coming up with rates so high, that's a sign of consumer stress where you have to actually liquidate the house. So there's two things. When you see interest rates go up, you're going to stay in the house because you've got a low mortgage. Say you got a 3% mortgage. And right now, I think last week, the 30-year mortgage on bank rate hit 8%, right? So if you're in a 3% mortgage, 3.5%, the last thing you want to do is sell your house and buy a new one and then go into an 8% mortgage. So that's been suppressing the transactions in the housing market. It's been actually limiting the supply. But what people are talking about in the chat is as consumer stress rises, and if you start to see those listings come up, that's a sign that people actually need the equity, and they need the equity so badly that they're willing to actually risk that higher change into a higher rate eventually. Maybe they're just going to sell the home and go and rent for a while, right? Because if you're going to sell the home from a 3% mortgage and go to 8%, that's painful. So the fact that
that's a
you've seen listings
downgrade.
go up, what's that?
I was going to say that's definitely downgrading your lifestyle. But
Yeah.
what about a home equity line? I mean, I'm sure it's expensive these days because back in the day, people used to just treat their houses as ATM machines when rates were kind of 1%, 2%, 3%. That's not the
Yeah.
case today, right? Because those loans are going to cost you about 9 or 10%.
Yeah, the HELOC, the home equity lines of credit have been this incredible economic shock absorber that's been in the U.S. economy for a long time. So, people had so much equity in their homes, they could just go to home equity line of credit and do an addition. And that's why if you look at Home Depot, the underperformance of Home Depot relative to the S&P is pretty spectacular. And it's because a lot of it has to do with that. Those home equity lines of credit are used to improve homes, to put on additions. And because there's not that extra reserve of cash, and right now, if you get a home equity line of credit, it's so expensive, and that's hurting companies. So the spread between Home Depot and the builders is very unusual, and it has a lot to do with the consumer stress relative to the housing market.
Do you think that a lot of these houses coming onto the market and a lot of these new listings are not 30-year fixed mortgages and are not people that own their houses outright? Do you think it's kind of the ARM mortgages and the variable rate mortgages that are coming on? What do you see?
Well, so one of the things we talked about in our book is like 2005, 6, 7, most people had adjustable rates in the United States. And so that's one of the things that caused the financial crisis because I think it was 60% of mortgages were adjustable. But then in 2020, after the financial crisis, people started locking in long-term mortgages. So right now it's actually reversed. 60% of mortgages in the United States are now fixed. So that's a good thing because people took advantage of those low interest rates and locked them in. The problem is the banks, like Bank of America is sitting on all these 3% mortgage pools. And so I think they have like $350 billion of losses in their hold to maturity book because so many people locked in those mortgages.
So, gosh, it doesn't look great for the American consumer. I mean, just looking at these numbers, looking at these charts, you have in a recession right now, even if the government isn't officially calling it a recession, and even if the president is saying we're in the greatest economy there's ever been. But Larry, let's go back quickly to the to the oil space because we've seen a huge sell-off in oil this week. If who bought ExxonMobil, and I saw it at 100. I thought it was a little expensive, and then it went to 20, and at 120 I pulled the trigger, and I just couldn't bear to watch it go up anymore. And then it was 100 again. Should I be worried if I own ExxonMobil at 120?
Well, you've got, since COVID, we've had what we call the Omicron and Delta variant shocks, which created a huge downdraft for energy stocks. And then we had the China lockdowns and what we call Evergrande, the property crisis in China. And those created big drawdowns for energy stocks. And now we have this latest economic shock that, the job market's starting to show a little weakness. The U.S. economy's, the Fed has stopped hiking because they're worried about something. Bank of America and Citigroup were down almost 50%. So there's a lot of stress in the system. And now that stress this week has shown up in oil. I mean, you get a 16 to 18% move down in oil in a very short period of time. And at the same time, bonds rallied. So those are really powerful economic indicators. But one thing I can tell you with the highest confidence, because the Saudis have so much control over oil prices, in other words, if they've been holding back production and they will continue to do so, the days of oil crashing down to like $14 to $25, I think, are over. There's just not enough supply of oil in the world relative to demand coming out of India, coming out of China. So even if we slow down in the United States, you want to use any sell-off, and as we've done with our Bear Traps trade alerts for the clients, and we did them the last 3 years, every time we've had a drawdown in energy stocks, we're there to buy. I think you're probably the third inning of a second, third inning of a 9 inning, multi-year bull market. And remember, the oil sector is only maybe 4 to 5, 4% of the S&P. And in past cycles, it's gotten up to close to 15, 16, even 18% of the S&P. And so,
right, that's interesting.
We think with the highest confidence that oil stocks are going to be within, and we talked about this in our book, within the next 10 years, oil stocks are going to be 10% of the S&P composition again. Right? That's with high confidence. So you just use these moments to kind of back up the track. But if you want to just, when you look at this chart, James, like what do you see? Like what questions would you want to ask when you see this?
Well, first of all, when I see the words cumulative advanced decline line, that is, those are 4 words that I would never put in a book. I would have to, I would have to really, dissect it so I could then explain it to a 12-year-old. If I don't understand it at that level, there's no way I can write about it. So what is a cumulative advanced decline line? Let's start there.
Well, every day in the market, there's advancing stocks and declining stocks, right? And so in a bull market, each day that goes by, there's more advancing stocks than declining stocks. So imagine like 20 days in a row, more advances than decline. That's a real bull market. And then so over time, that more advances versus declines, you can calculate this in the cumulative New York Stock Exchange advanced decline line. And as you can see on the right-hand side of that screen, like if you're trying to manage money and buy dips in the market and you want to invest money in kind of there's no such thing as a safe market, but a safer market is when on that left-hand side of the screen, when you've got that cumulative advanced decline line that's staying above the 50-day moving average.
So I got it, Larry. So to put it in simple English, this is a winners and losers line, right? When the line is going up, there are more winners than losers. And when the line is going down, there are more losers than winners.
Exactly. And you know what? It's
okay.
When the line's going down over longer periods of time, it's a sign that real money is leaving the market. And so there's different periods of time where real money's coming into what I call real money is mutual funds, like pension funds. These are real money investors. They don't day trade. They're just long term. But this is a sign that real money is actually leaving the market and probably going into bonds, maybe going into commodities, maybe going into global equities, maybe because global equities right now are the most underowned relative to the U.S. in probably in our lifetimes. Like
Yeah.
nobody owns large cap global value stocks. Like nobody. 10 years ago, everybody loved them. Now nobody owns. Everybody is literally there's $18 trillion in the Nasdaq 100. $18 trillion. In 2000, like 11, 12, 13, the oil sector was equal with the Nasdaq 100 in terms of value, and now the Nasdaq 100 has, I think, $5 or $6 trillion more than the oil sector, just alone. And so this is a sign that money is leaving the market. And what I'd say is if you just look at this chart, whenever you go below that 50-day moving average, and stay there for a little bit, that's typically a sign of a pretty big drawdown. As you can see there, the drawdowns in the S&P, the 21 and the 22, both came. One great early risk indicator is when you go below that 50-day moving average. You always want to keep your guard up, because once you go below that 50-day moving average, that means that the decliners versus the advances are really picking up.
Right, I see. So, yeah, it makes perfect sense. On the left-hand side, you can see a healthy bull market. I actually can't see the dates on this, Larry, but what's that healthy bull versus the right-hand side of the chart? What's the time span? Is it 2 years, 1 year?
This is a 5-year chart, so that's going back to
Okay.
Late 2020, 21.
Mm-hmm.
And this, if you went back further, after Trump was elected, like 2017, 18, 19, literally it was just straight up the whole way. The amount of advances versus declines was a very healthy bull market, and so you just want to be careful when that cumulative advance decline line is going sideways to down. It kind of means that some money's leaving the market, and that's the problem. When you're in the fourth quarter and you have treasuries that are paying 5%, which if you think about the last 30 years, we've really never had that last 25, 30 years. So if you're up like 5 or 10%, and all of a sudden there's a little volatility in the market, you can just pull your money out and go, put it in a 1 or 2 year bond and get 5%, and that's very enticing. 2 years ago, that was less than 1% for bonds, half a percent. And so
Right.
I think the bond market's actually draining money out of the stock market.
Well, it is, because the rates are too attractive. Why would you risk making 9% in the S&P 500 where you can get a guaranteed 5 or 6 in the Treasury market right now?
Exactly.
And to that point, Larry, I mean, this all plays into the inflation trade, and I think the other story this week that you've been talking about has been the precious metal space. Okay, so Larry, listen, going back to the inflation conversation, how would you reassure an investor and a trader who about the inflation trade? Let's assume that they are staying long their precious metal stocks, and the miners and the industrials, companies like Vale, FCX. But I was stunned when I looked at the Newmont mining chart. It's at $34, and I traced it back. That is the June 10th level from 2019, which, looking at that chart, it would suggest that there's no inflation whatsoever. So how do you reassure people to, stay long? Let's assume they didn't get Newmont under $40 because it's been kind of above $40 for such a long time. They're long at 50. Where's it going? Should they cut their losses? What do you tell them?
Well, whenever you come to the end of a hiking cycle, historically, it's an incredible opportunity to get long precious metals companies. Even in the platinum space, palladium, gold, silver, those are the big ones. And so companies that tread in these waters have been beaten down because you've got the tax loss pain. So as you come into that fourth quarter, you've got about the market's up like 14% this year on the S&P, and people need losses. So they're willing to sell. They want to sell stocks that they're down on, and they can buy them back in 31 days, take the loss. And so last year, we were having our conference in Panama, and we talked about this around that terrific pressure, that tax loss pressure. And so when you come into the new year, that's gone. And then inflation has been pushed down by the Fed by all these rate hikes. But then when you go into a rate cutting cycle into next year, job losses are starting to pile up. We think we're in recession now. Tax receipts start to come down, and next thing you know, the Fed has to ease, and next year inflation picks up again. So as you can see here in the chart, the junior gold miners are the cheapest to gold pretty much all time. And these are companies that are smaller companies in the gold space. The GDXJ is the cheapest to the GLD or gold in pretty much in 20 years. It's one of the cheapest levels. Newmont is a major. They just went through a very confusing acquisition, and their reporting of their earnings during that period annoyed some investors in the chat, especially some institutional investors that were really annoyed with the management of Newmont and kind of like the way that they've actually taken on some losses over the last couple of quarters. So management has lost the confidence of some investors and Newmont. I'm hearing much better things about Agnico Eagle, AEM.
But Larry, to interrupt, do you like Newmont? Do you still like Newmont?
Yeah, I do. But I think if you had to pick one horse for the next couple of years, you maybe jump on Agnico because they're both. I don't get me wrong. I love Newmont, and I think.
What about Barrick Gold?
Barrick, yeah. Well, the gold miners here are literally a century Hall of Fame buy because you're at the end of an unrealistic hiking cycle where the Fed has probably hiked 100 to 150 bips too much. They've created so much stress in commercial real estate, so much stress on the consumer side that's all going to matriculate out over the next couple of months. They'll be cutting rates aggressively this time. Next summer we're going to cut rates by 100 basis points by next July, August, because that's how bad things could get. And when they do that, that's when there's going to be this rush out of financial assets. Right now, there's 18 trillion in the NASDAQ 100. That number there was 12 trillion in January, right? 12 trillion in December, January, and now there's 18 trillion in the NASDAQ 100. And so next year, that 18 trillion is going to come out and go into value stocks, hard assets, gold, silver, and the gold mining space is like literally less than $300 billion. It's tiny. It's just absolutely a joke. I mean,
that's unbelievable.
Elon Musk has like second and third wives that alimony is more than the entire uranium and gold space. And so, I mean, it's a generational buying opportunity for these stocks. The entire uranium sector is less than 40 billion. And the entire
so Larry, what's the timeline on this type of a trade? I mean, you just said kind of June we'll be off to the races with these, but what's the timeline on say Newmont or Barrick Gold, and what's the price to get?
Well, I think what's really sexy about the trade in terms of timing is when if you ever have the end of a hiking cycle, if it ends in the fourth quarter, at the same time as all that selling pressure on tax losses, that means that your timing is like, your best time to buy is November, December, because you've got that tax loss pressure every single day. People want to take the loss on some of these. Say you're up on Coca-Cola or whatever, you're up on Microsoft, you want to sell your gold miners and buy them back in 31 days. So the timing for that is X. And at the same time, with the chart we showed earlier, continuing claims breaking out. When continuing claims breaking out, that means you're getting closer and closer to Fed cuts, Fed rate cuts. But the most important thing is, like 4 months ago, the Fed was in one direction, right? Think about this. This is the most important part of the conversation. And this applies right to the gold miners, applies to emerging markets. I'm talking about Fed speak. So if you watch the Fed governors, if you listen to Powell, he comes out with it 4 months ago. If he came out with a message, and then all the governors would essentially back him up. They were all going in one direction. 4, 5, 6 months ago, they were all going toward a more higher interest rate regime, trying to slow down inflation. Now it's good cop, bad cop. Last week, Powell was opening the door to a combination. Today, he slams it. The different governors this week, Logan and Bowman came out, kind of contradicting Powell. So when the Fed governors are going back and forth, that's not opening the door to accumulation, to accommodation. And in the fourth quarter, if that's happening, and you're in the gold miners, it's going to force people to just puke them out. And you want to take advantage of that puke, because by March, April, May, I'm convinced that all the Fed governors, instead of going good cop, bad cop, they're all going to be going in one direction. And that's toward a softer path. And when
Now,
that
what
happens,
will that direction be, Larry?
toward a softer path, toward a combination, toward rate cuts.
That's
The
rate
question,
cuts.
yeah,
That's
the question
printing
right
more
now
money.
is, the question right now, James, is, okay, should we hike more or stop, right? Hike more, that's the debate. The debate in 5 months, in 4 months, in 3 months is going to be one cut or 75 basis points. It's going to be all cuts, and once you go that direction, the gold miners typically can move 50, 60, 70% in a very short order. We saw this in 2016. We saw this in 2018. Once they commit to a new direction, you're off to the races with the gold miners. And right now, if you buy the GDXJ, it's the cheapest to gold in over a decade, I think. It's one of the cheapest.
And is that, when they cut rates, is it because they just cannot afford to cut rates, and that's going to just put way too much pressure on the debt? I mean, how does that kind of translate? Or are they going to be trying to save the markets from really going to hell in a handbasket? They have to throw the businesses a bone. Like, listen, we have to make lending cheaper, as we're going to knock out the economy completely.
Yeah, well, they've crushed the middle class consumer, because, like I said, auto loans, finance an auto loan, any kind of subprime loan, credit cards are like close to 30%. 30%. This is the last.
Crazy.
The last hiking cycle, the credit cards got up to 20. Now they're close to 30. So the Fed has to cut. They're crushing the middle class, and they're crushing a lot of companies in a lot of different sectors. Like you said, they're crushing auto finance. Auto finance is a disaster, and they're crushing commercial real estate. I mean, I was on a call with this famous family office that they own. They own a ton of commercial real estate, and their chief, they have this asset manager in the commercial real estate space, and the chief economist from the asset manager, the last 4 or 5 conference calls over the last year, so every quarter, has been coming out and saying, oh, we're going to get those lower rates next year, and this has been going on. Basically, and all this time, Powell's been getting more and more hawkish, and so if you're in commercial real estate, a lot of these people have been holding on for over a year and a half for rate cuts, and the Fed's has been pushing things up more. So all that commercial real estate is under so much pressure. And he told me they fired the economist on the spot, because he's been telling them, for a year, that rates were going to come down, and now rates are really sticky up here, and that because right now, if say you own a building in New York and you're financed at 2.5% or 3%, and now that same financing for that same building might be 8, 9, 10%, and so the economics of the rents, the whole thing, the management of the building doesn't work anymore. And so all these buildings are trading 50, a lot of them are trading 50% down in value, and those buildings are on bank balance sheets. So all this is just, a real disaster that's starting to come to the surface if you listen carefully, and that's what's going to stop the Fed.
And so all of this effort around trying to get inflation down is going to totally backfire. Is that kind of what you're saying, in essence? Is that they're going to have to cut rates, and that is when inflation will really take off?
Yes, it's in order to kill inflation, they have to do so much on rate hikes that creates such social pressure, because middle class families are think about a middle class family versus someone in Palm Beach with $10 million. If you're in $10 million in Palm Beach, you're sitting poolside, and you now have $550,000 of interest from your treasury bills in your money market fund. On your $10 million, you got $550,000. And a year and a half ago, that same person had $70,000 of interest. So you went from 70 to 80 to 90,000 of interest annually, to 400 to 550. So they've gotten this huge pay raise. So the Fed basically took rich people in Palm Beach and gave them a huge pay raise. But if you're that middle class family in Oklahoma or Detroit, and
living off credit cards and home equity lines,
this family's being just persecuted by the Fed. And so this whole thing is just not, it's crushing the middle class. That's why you look in the S&P, and the companies that face large portions of the US population are crushed, whereas companies like Ferrari are reporting better than expected numbers over and over again. So it's a two-tiered economy right now, and the Fed has to end that.
Well, also for the United States, it's socially unsustainable to have inequality. It was bad enough before all of this, but then to really exacerbate it by giving the rich a pay raise and killing the lower classes and middle classes even more, it's, that's when the fabric of society starts to come apart.
Yeah, and then when you have an election coming up, that elections always change the Federal Reserve, and that's another reason why the Fed's going to be in a softer path next year, which is good news for the gold miners. It's good news for platinum, good news for emerging markets, the EEM, the EMLC. There's a whole basket of, and Valentina can actually make an introduction, bring back Valentina, but if you want to reach out to us, we do have this basket of Fed is done trades for 2024.
What was it called? It was called the backfire basket or something, wasn't it, Larry?
Well, that was our 2000, but this is now our tax law say Fed is done basket.
Oh.
But Valentina, you want to kick it off?
Okay, thank you, James, and thank you, Larry, for such wonderful insight. As you guys saw, why we chose James to be the author of this new book. He knows how to translate all of these finance lingo into everyday, for me to understand and for you to understand that you're learning, you're growing. So we're really grateful for you guys to be here. Of course, you can reach me at valentina@theredshopsreport.com. You can reach out to my email and you can get a 21-day trial. Of course, you can also reach out to me and you can get a trial on our Bloomberg live chat, the one that Larry has behind him. We're really grateful and thank you very much. See you next time.